Hello, this is Joe Hoyle here at the University of Richmond and the author of your financial accounting textbook, talking with you today about the topic of deferred income taxes. If you look at a set of financial statements for almost any company in the country and look under liabilities, it's likely that you'll find a deferred income tax. Now, one of the things I really want is for my students to be able to look at a set of financial statements and understand, at least at a basic level, what those accounts mean. So when you pick up a set of financial statements and you see under liabilities, deferred income taxes, do you know what that means, or do you simply say, I'm never going to understand that? Well, you can understand that. That is something that companies do. There's a reason for it, and you should be able to understand what they are doing when they report that deferred income tax. So in this question, your uncle, who owns, with some friends, an office supply store, has sold a couple of acres of land behind one of the stores. And he's interested in how this sale is going to impact his net income. Now, what has happened here is they have sold the land at a fairly significant gain, but they're not going to collect the money for some period of time. And according to the U.S. tax laws, you can, under certain circumstances, wait to pay your taxes until you collect the money. The idea is kind of obvious. The government realizes that if you've not yet collected the money, you may not have the money to pay the taxes. So when you get the cash, they want their share. The government wants its share. So in this particular case, even though your uncle's store has already sold the land and already has reported the gain, the taxes won't have to be paid for some period of time, won't have to be paid until the buyer makes the payments. Now, the question that your uncle poses, which is a very valid question, how do I report this? I made the sale this year, but the taxes won't even hit my tax return for a couple of years. What do I do about that? Well, accounting over the years has faced this issue because companies want to put off paying their taxes. The reason they want to put off paying their taxes is very obvious. As soon as they pay the money, they cannot use that cash any longer. But if they can figure out ways to put off making that payment, then they can make use of that money for a longer period of time. So you're saving that tax money, you're using that tax money, you're improving, you hope, your income for this year. So how is this reported? Well, the sale was made this year, the gain is reported this year. And because the sale was made this year, the income tax expense, because of the matching principle, should also be reported in the same year. Even if you're not going to pay the income taxes for 2 or 3 or 4 years, what created that tax happened this year. If what created that tax happened this year, then the income tax expense should also be recorded this year. So your uncle's going to have to debit income tax expense. However, you want to let decision makers know that even though the expense has been incurred, payment does not have to be made yet. So instead of crediting something like income tax payable, which would imply you're going to have to make the payment very quickly, in accounting we've come up with this term deferred income tax liability, which means that even though the income was earned this year, through use of the tax laws, we've been able to put off paying that income tax for a couple of years. So this is, in my own classes, this is a point where I tell the students, this is the one liability you actually like. Most companies do not like to report liabilities. They think it makes them look bad. But a deferred income tax liability indicates that you've come up with some way to pay your taxes at a later point in time. And since you're paying your taxes at a later point in time, you're getting to use that money for a longer period. So whenever you look at liabilities, yes, liabilities indicates payments in the future. But a deferred income tax liability is probably something the company has tried to do. And why have they tried to do this? So they can hold on to that money for a longer period of time. So in this chapter, We're dealing with a number of different types of liabilities. This chapter talks about, for example, lease liabilities, and now we've talked about deferred income tax liabilities. And the reason is that when you pick up a balance sheet and you see those liabilities, I want you to know what they mean and where they came from. And this is a good example of how a company manages to create a deferred income tax liability. Have a great day. Hope your class is going well. Hope you're getting ready to make an A+.